All right, good to have you back with us on the Halftime Report. Shares of Marriott hovering around bear market territory. They're down 19% since the beginning of the year. Goldman Sachs, though, doubling down on its bullish call. They reiterate the buy rating, add it to the conviction buy list. They do cut the price target by a few bucks. We made it our call of the day. Joe, you used to own it.
I did.
What do you think of it here?
I think this is more of a call where they're replacing Wyndham, which was on the conviction buy list, and now they're adding Marriott and highlighting the value in Marriott. I agree with it. I think investors are making the mistake looking at Marriott as a very cyclically sensitive type of company.
That's right. They say it's not,
different.
right? They say they're so asset light
that
they should be immune to any meaningful downturn.
I would agree with that, and they've proven in the past that they are. I think the reason for the decline is less about what's going on globally, and it's more about the Starwood integration. And that Starwood integration now is getting into the later part of the cycle, and I think you're going to be beginning to see the benefits of it. So I agree with this call. It's not a name that I have in the portfolio right now. It's a name that I have had in the past. It's around 120. It probably gets me excited if it continues to hold further gains.
Yeah, to your point, Judge, was down 19% or more, has rallied 6% in the last month. I like it here, just like Joe, and one of my reasons is exactly what they cite. They are asset light, Judge. So when you see the interest rates picking up, you might say to some folks who actually own most of their hotels, okay, this is an additional cost they have to bear. These guys, it's a branding. It's like those folks that own the Calvin Klein labels and so forth that produce those shirts, but they don't have the problems that the brick and mortar stores have because these guys are just a brand distributor.
Yeah, right. They manage the
That's
properties.
what these guys
don't own the properties.
Yeah, 26 different brands or something like that between Starwood and Marriott. So it's a ton of brands, and people get on the platform because they need to get the exposure.
No, they do have great assets. They have an amazing management team, and they have a growing and recurring fee-based business, which is very important, which makes them less cyclical. But they did have some stumbles in their quarter.
Oh, yeah, they did.
Leisure was very disappointing, and the rest of the peers did not have problems with leisure. Business was good, but you have to ask yourself, if the economy is slowing, how strong does business remain? And so there is that cycle concern. And oh, by the way, it's trading at 19 times forward estimates. I don't find that cheap. That's a premium to the market.
They say trough valuation.
There are a lot of uncertainties, and they also have a lot of uncertainties with regards to the Starwood integration. They really have had struggles with that.
Yeah.
And people
it's cited in the note.
You know, in the note,
right.
They also talked about deterioration, right? And that's one of the major issues, I think. The demand, business demand. So that's a problem, right? I mean, they do have quality. That's the difference. Let's not forget, this same analyst, June 25th, when he put him on the conviction buy list for Wyndham, it's down 23%. So you got to keep that in mind, too. Is this the correct call at the right time? I'm not so sure. I think it's a little bit high value right now.
I did a deep dive on this one about 2 quarters ago, and I learned something interesting. They lose up to 23% of the margin on each room by brokers online. In other words, if you use a service to go and search for the lowest cost near LaGuardia, and you don't book directly on their platform, they lose 20 to 23%. The entire profit of the room stay, basically. This strategy of integrating brands is all about an affinity program to get you to book within their system and cut out the middlemen. You won't know if you've been successful with this name for another year, but if they do that, if they all of a sudden say, okay, if I'm looking for a room, I'm going to go onto their platform and not any Travelocity or anything else, they'll have won this war. It is a war between the aggregators and the direct platforms. That's what this whole thing's about. That's why you can continue to see consolidation. It depends how you book the room. If you book it through an aggregator, they make no money.
Well, the RevPAR growth is coming back, and you also have the stock buyback. So, listen, for me, I just think it's seen the worst so far.